Hey, what's up, everybody? Interest rates are on the rise, as you've probably heard. You've also probably heard that this is bad news for stocks. Why is that? What kinds of stocks will do better than others in a high interest rate environment? In this video, I plan to cover all of that, as well as tell you what I'm doing with my personal investment portfolio in response to these rising interest rates. If you're new to the channel, my name is Dan. I do a lot of stock analysis videos on this channel. So if you like that kind of thing, hit the subscribe button to see more. Okay, let's get into it. Alright guys, so this chart shows the federal funds rate. This rate really sets the tone for all other short-term interest rates. And as you can see here, we're really at an all-time low, in fact. And if we zoom in a bit more, let's just look at the past year. Yeah, we're hovering, at 0.05%, 0.09%. So we are at all-time lows. However, it's quite a different picture for the longer-term interest rates. So the Fed actually has very little control over longer-term rates, like what we're looking at here. This is the 10-year Treasury rate. And as you can see, it's really been rising this year in 2021. So we hit an all-time low. We were at like 0.5% back in August. It went up a little bit, but nobody was too concerned. Well, recently it's gone from 1% at the end of January all the way up to about 1.5% today. So that's quite a rise. Now, if we zoom out a bit, we can put it in context. We're looking at the past 10 years. Yes, the rate has been much higher. As recently as 2018, it was over 3%. So 1.5 is really not so high, but it certainly has people concerned. And predictably, we are seeing the same thing in 30-year interest rates, which had hit an all-time low there, about 2.5%. Those have risen very sharply at the beginning of this year, and they're currently sitting at about 3%. Again, historically, let's zoom out, let's look at 10 years. We're still pretty low historically, but this sudden quick rise has got a lot of people concerned. They're thinking to the future. They're thinking, how high is it going to go? Okay, so rates are rising. What does this mean though? You've probably heard that rising rates are bad for stocks, and you guys probably saw how the stock market generally has been going down the last few weeks. Why is that, and why are some stocks affected more than others? Well, let's get into it. Well, there's a couple ways of explaining what's going on. The most common sense way to explain it is corporate investments. So some stocks are going to be hurt by higher interest rates more than others. And it has to do with their investment level. So you think about growth stocks, they need to make heavy investments today for payoffs far into the future. So as the interest rates go up, that really discourages investments for them. They don't really want to borrow as much, and that hurts their value. Compare that to value stocks who don't really need to make any further investments in some cases, or if they do, they are not really so huge. It's not going to hurt their value nearly as much. The other way to explain what's going on is a little more technical, a little more mathematical, but the idea is very simple, guys. The value of any asset is equal to the stream of cash you're going to get from owning that asset, and you have to discount the cash flows in the future by 1 plus R, where R is your discount rate. And so this little R is quite influential in coming up with the ultimate value of a company. Now, as the interest rates rise, that little R goes up because the risk-free rate is going up. Investors need to require a higher rate of return to invest. And so the value of all companies goes down. Why does it go down more for growth stocks compared to value stocks? Well, the thing about value stocks is most of their payments are up front. They're in the next few years. Whereas for growth stocks, they really might not be getting any cash to you for a whole decade or more. And so, their dividend payments are far into the future, and that little R has a heavier weight on the ultimate outcome there. Alright guys, so let's talk about how rising interest rates affect the value of stocks generally and how they affect the value of value stocks versus growth stocks very differently. So let's have a look here at boring value stock and a growth stock. Both stocks have a stream of dividends. With the value stock, you have more dividend payments up front. This is a company that's already making a lot of money. And so beyond that, the dividend doesn't really grow by much. You can see it going from $5 to $5.25 to $5.51 and so on. With the growth stock, it's very different. They're not going to give you any money for the next 3 years. When they finally do pay a dividend, it's only going to be $2. Then it goes up to $4, $6, and finally it gets up to $22 by year 10. So if we use a 6% discount rate, the value of the value stock and the growth stock is actually very, very close to being the same. But what happens when that interest rate rises? Well, what you're going to see, if it goes from 6 to 10, let's see what we get here. The value of both stocks goes down because you have to divide by a larger, R there, 1 plus R. As R goes up, the value goes down. But notice something. The value stock went down to about 37.20. The growth stock went down to 33.57. So the value stock went down by less. And this effect can be seen. You can pick any interest rate. It doesn't just work for 10. You can plug in 12. There's a substantial difference in the drop for the growth stock compared to the value stock. So you take a company like Tesla, for example. Tesla's cash flows to shareholders are far into the future. They're nowhere near that level yet in the cycle of their company. So their value really got hit the most over the past month, losing about 30%. Now, it's still one of the most overvalued stocks in the market that I've ever seen. They're expected to earn about $4 a share next year. The market says they're worth about $600 a share, but that's a topic for another video. You got companies like Square as well, down 10%, or Adobe down about 10.5%. So, these growth type companies, they're going to get hit the most. Whereas, more value-oriented stocks, you got cigarette companies like Altria Group. They're actually up 6% over the past month. You've got some military stocks that I recommended, like Huntington Ingalls Industries. They're actually up 13% last month, and L3 Harris Technologies up about 2.3 as well. The S&P is also down for February, although it's only down 1.15%. A lot of people's favorite stocks are down more than that. We have the S&P 500, just the growth stock portion of that is down close to 6% over the past month. What's very interesting, guys, is that if you look at VOOV, which is Vanguard's S&P 500 Value Fund, that is actually up 4.26% during the past month. Also interesting, the price of gold has gone down very substantially in the past month, and also the price of silver. Alright guys, so what can you do about these rising rates as an investor? Well, the first thing I would do is hit that like button. Gotcha. Okay, seriously though, I think you clearly want to avoid being too overweighted in growth stocks. A lot of people viewed this as a buying opportunity. I admit I did buy some Adobe because it went down below the price that I said what I would buy at in my video. So that is a growth stock that I bought recently. However, it represents a pretty small percentage of my portfolio, and I want to keep it that way. The reason is we really don't know how high these rates are going to go and how fast. So while I'm not running away from growth stocks completely, I am making sure they don't represent a significant portion of my portfolio. One industry to consider is the banking industry. Banking profits are generally a function of the interest rate. Banks like higher interest rates, so that's something to consider. And of course, value stocks, and I'm going to go over a few that I like. I still really like Kroger. As you guys know, I've made 2 videos on it. It's one of my favorite picks. I diversify a little bit. I also have a position in Ahold Delhaize, another grocery store. I love tobacco stocks. If you haven't seen my video on that, you can check that out. I'll probably make another one pretty soon. But here is British American Tobacco, one of my favorites, currently trading at about 9.5 times earnings with a dividend yield of about 8%. There's also Altria Group, another cigarette company that's been doing very well lately. And military stocks in general are very unloved by the market right now. I really don't understand why. I think we're going to see a lot more wars with the new administration. You've got Lockheed Martin trading at about 13 times earnings, yielding about 3%. You've got Huntington Ingalls Industries. You've got L3 Harris. And so I've made videos about all of these. I probably need to make an update on LMT, but the others are pretty recent. They're still pretty good values. Alright guys, so I hope you enjoyed the video. That is just going to be my strategy, is to invest in tobacco, grocery stores, military stocks, that kind of thing. Very defensive, unlikely to deliver me any kind of spectacular return. But in my view, pretty likely to beat the market when I see the market could actually be going down in the near future. So that's where I'm at. However, it really depends what you think about interest rates going forward. People are pretty scared right now. The interest rates have gone up pretty quickly and by a significant amount. If you think this is only the beginning, if you think the rates are going to climb even higher, yeah, you should totally dump all of your growth stocks. You might even just hold cash, right? But if you think that this is temporary, the rate's really not going to keep climbing that high, this actually would represent a great buying opportunity for those growth stocks. So it really depends on your expectations going forward. Just something to keep in mind. But again, that's just for me. That's what I'm going to do. Hope you guys enjoyed the video. Thank you for watching.